Good evening, class. Today our group is here to discuss property and liability insurance. These are group members, myself, Thomas, Ari, and Mitchell. The first section we'll be discussing is home insurance and the different package policies that go within it. So first things first, why should we have home insurance in the first place? It's necessary in order to prepare for the worst possible outcomes. We don't always expect a fire or a flood to come, but in the rare instance that it does, we need to be protected. And property insurance or home insurance is valuable because it allows individuals to pool together the associated financial risks of these perils and protect us from catastrophic losses that otherwise would have been very harmful. And as with other insurances that we've discussed in the past, the real challenge doesn't really come with deciding whether or not we want to have the insurance, but instead it comes from deciding how much of the insurance we want to purchase. We don't want to be underinsured to the point where we're still facing a large risk, but on the other hand, we don't want to be wasting money by being overinsured. Now, before discussing the package policies, the typical package policies of each home insurance, we want to know what makes up a home insurance policy. And it's divided into two sections. The first section is property coverage. This portion specifies the dollar amount that the insurance company will pay for a claim. So whatever dollar amount you arrive at for this first section, that will be the maximum amount that the insurance company will pay for any given claim. And this section is broken out into four basic coverage components. Coverage A, dwelling, B, other structures, C, personal property, and D, loss of use. These will be covered in greater detail in the following slide. Until then, we have the second section, which is personal liability coverage. This portion protects policyholders from injury on their property as a result of their actions. So you're protected from liability lawsuits, although the minimum claim must be over $100,000. And as well, this section could also be viewed as a small medical insurance policy because any injuries to non-family members on your property can be insured up to $1,000 each. And this section covers most liabilities, with the only exceptions being liabilities that come from business, professional use, or negligence. Continuing this topic, as I mentioned before, the four basic coverage components, now going into greater detail. The first one, coverage A, dwelling, protects the home and any attachments to it. So you can imagine the garage of a home. If this sustains any damage, you will receive a claim and receive payment and protection for it. However, if, say, the land around the garage was damaged, you would not receive any protection based on coverage A. For coverage B, other structures, this protects other structures on the premises that are not attached to the house. For example, you can think of an outhouse or a detached garage, and this is limited to 10% of the total insurance policy. So if your home is covered for $100,000, coverage B is limited to only 10% of this, so in this case, $10,000. For coverage C, personal property, this protects any personal property used or owned by the policyholder, regardless of the location. So for instance, if you're vacationing in another country and your watch or purse gets stolen, you would be covered under coverage C. This is limited to 50% of the total insurance policy. And another instance that you're protecting coverage C would be if you're, say, hosting a party and there's a fire in the home, everyone makes out safe, but someone's property was left inside, a guest, and it was lost, you would also be covered for this. Though it is important to note there are certain exclusions that limit the amount that you could be reimbursed for. Lastly, we have coverage D. This is loss of use. This provides benefits if your home cannot be used because of an insured loss. This is broken out into three different sections. The first one is additional living expenses. So you would be reimbursed for the cost of living in another space. The second would be fair rental value. Say you're renting a room in your home for $500 a month and your home is uninhabitable for 2 months, you would be reimbursed for $1,000. And the last one is prohibited use, And with this section, you'd be reimbursed in the case that your home is declared uninhabitable by an authority. Think about an example where your neighbor has a gas leak and you're forced to move out. You would be provided or reimbursed for 2 weeks worth of living expenses. Now, with those four basic coverage components covered, the last section would be perils. And a peril is an event or happening, whether natural or man-made, that causes a financial loss. You can think of a flood, a fire, or theft as common perils. And there are types of insurance or home insurance policies, and there's different types. One being named perils, which covers a specific set of perils. If not specifically named, it is not covered. And the other being open perils, which covers all the perils except for specific exclusions. So for each home insurance policy, you'll have the two different sections. Section 1 having the four basic coverage components. Section 2 having the liability insurance, and within this you'll have either named or open peril policies. Depending on which one you pick, that will greatly impact the coverage. Now that we understand everything that goes into a home insurance policy, we can look at package policies, which are packages that insurance companies offer their customers where they can select different packages based off of how much coverage they want or their living spaces. And homeowners policies are commonly referred to as HOs. As we can see, for our purposes, there are 6 types of policies. They're listed down below here, down on the left. There's basic, broad, all risk, renters, condominium, and older home forms. And from the image to the right, we can see that these differ based off of whether they have dwelling coverage, personal belonging coverage, liability coverage, and as well as their different peril policies. So for the first two I mentioned, these would be considered basic policies for homeowners. The first one, basic form, is a policy that provides narrow coverage. And in fact, it's so narrow that it's not covered in some states. It is a named peril policy, and some of the covered perils that you would have if you had HO1, the basic form, would be theft, fire, explosion, as well as others. The second is broad form, and this policy provides all the benefits of HO1, except it does add some more covered perils, even though it still is a named perils policy. But since it does add extra perils, it does typically cost 5 to 10% more than HO1. And some of the additional perils that are covered would be falling objects or tearing or freezing of home appliances. The third would be all risk form, and this is a policy that covers all direct physical losses to your home. This is an open perils policy as opposed to the previous two. And as a result of it being open perils, it costs 10 to 15% more than basic form. And to give you an idea of what some of the excluded perils could look like, this would be an earthquake, a war, or a nuclear accident, so highly unlikely events. And now moving on to the specialized policies for homeowners, this would include renters form, which would be a policy aimed at renters or tenants that covers personal belongings, however it does not offer personal liability insurance. And since they are renting a space and not actually owning the home, coverages A and B are not applicable in this case. Next, we have condominium, which is a policy that provides property and liability insurance for condominium or co-op owners. And finally, older homes policy that insures homes for repair costs or actual cash value rather than replacement costs, just because it makes more sense, just because you're likely to repair the home more than actually replacing it. And finally, a note that all policies do include personal liability insurance up to $100,000, as well as medical payments to others up to $1,000 per person, as we mentioned previously. And based off these different package policies, it's clear that we can see that you can select based off of how much coverage you want, or if you have a particular dwelling space, that would also make a difference in which one you pick. But now that we understand that, I can pass it on to Thomas, who's going to be talking about supplemental coverage.
Good afternoon, guys. My name is Tomas, and I will be discussing supplemental coverage and coinsurance, which is the next section of Chapter 10. At the end of the day, everybody has different insurance needs. So depending on the type, dollar value of the assets, or the risk that you're exposed to, you might want to consider different supplemental coverages. There are several types of supplemental coverages that are very common. And basically what you're doing with supplemental coverages is that you're customizing your insurance policy through endorsements. An endorsement is basically an add-on to an insurance policy. You can also remove endorsements from your insurance policy to pay for what you want to pay and to cover the assets that you want to cover. So everybody can have a customizable insurance policy that fits their needs. So first, I will be discussing personal article floaters. Basically, what this is an extended coverage on personal items. You're placing insurance on items that you find valuable that are not covered by your homeowner's insurance. It's usually sold as an extension for homeowner's insurance policy on an all-risk basis. This is very common in items such as jewelry that have a lot of value, and if it's misplaced or it's destroyed for a reason, your personal article floater will cover it. However, there are some exceptions to this. Usually it excludes war, wear and tear, mechanical breakdown, vermin, and nuclear disaster, which would be very unfortunate if you lost an item due to a nuclear disaster. But personal article floaters are very important to some people who have a lot of valuables and their assets are worth a lot. To keep in mind that That's why it's an add-on, because some people rather not pay extra for their valuables, because there's certain coverage in your homeowner's policy that will cover for personal items. But if you want to protect your assets more, personal article floater is a very good way to cover for valuables. As you guys can see by the name, earthquake coverage does exactly what the name says. So it is usually included in standardized homeowners insurance policies because basically the risk of an earthquake varies on where you live. Let's say Miami, it's not very common to have earthquakes. So most people probably are not paying for earthquake coverage in their houses, in their homeowners insurance policy. But if you live in areas such as California, you actually might want to consider having earthquake coverage in your homeowners insurance. As you can see, coverage varies on the risk. For example, if you're living in California, it is high risk area. Most likely you're paying for around $4 per $1,000 of the value of your house. So let's say, for example, you own a $200,000 home in California. If you decide to pay for earthquake coverage, then you'll be paying annually around $800 for your $200,000 home. But then again, this is excluded from most insurance policies because depending on where you live, it is a risk that not everybody has. And that's why it's a supplemental coverage. As for flood protection, it's actually a very common and required supplemental coverage in your homeowner's insurance. Floods are actually the top natural disaster in the United States for insurance policy brokers. They're usually the most common and the ones that cause the most damage to houses. So flood protection does not only cover a flood, but any type of water damage due to hurricanes, mudslides, or unusual erosion. And since it's so common and it's the most costly natural disaster for insurance companies, it is generally administered and subsidized by the federal government and is required in many places. For example, here in Miami, Florida, you're required to have flood protection in your homeowner's insurance because hurricanes are common, and therefore your community must comply with the housing and urban development requirements in order to be eligible for this flood protection. Once your community is eligible, you can purchase up to $250,000 of coverage and an additional $1,100 on your personal items and the stuff that is inside your house. Again, since it's so common, the federal government has to subsidize this cost, so most people are actually protected from floods. Next up, I will be discussing what is called an insurance guard, which is also an addition to your homeowner's insurance. Basically, as we know, in the US, the rate of inflation is around 2% per year. So what an inflation guard is basically protecting your policy for the basis of the increase in cost, or you're basically exposing yourself. You're not exposing yourself. You're protecting yourself from the risk of having of inflation. Basically, if you add an insurance guard to your insurance policy, your policy gets updated every year. Let's say that from the year to the next, your insurance policy might go up by 2% because that was the rate of inflation for the year before. And basically, it's important because you're covering, not only you're paying more for your insurance policy, but also your costs, your coverage is higher. And most people actually decide to get inflation guard because it protects them from the risk of your house increasing in value. And if anything happens to your house and you do not have an inflation guard, your policy will be outdated. With inflation guard, every single year, your coverage will be higher by that rate, generally around 2 to 5%. And you can be more relaxed knowing that year after year, you'll be protected for this inflation. At least this next part is very important because personal property replacement cost coverage is actually different than the cost coverage of a homeowner's insurance policy. So homeowner's policy pays the actual cash value of your loss. This cash value is calculated by subtracting the depreciation from the replacement cost. But personal property insurance does not work the same. In most cases, you can actually pay lower than the actual cost of replacing an asset. If you have a very valuable asset that you want to protect, and it's personal property, you might want to consider replacement cost coverage. This is a supplemental cost that instead of paying the actual cost value of the asset that you lost and needs to be replaced, will provide an actual replacement cost of the destroyed asset. So instead of getting the cash value, it basically give you the cost of replacing that asset. For personal property insurance, it can actually be added by the initial cost of around 5 to 50% of homeowners insurance. And some people that have really high value assets like a lot, they use this coverage a lot because you can be better protected in case that a valuable is destroyed. There can be a lot of discrepancy in the price that you get from a personal property. That's why this 5 to 15% cost can actually be a really good option. Next up is added liability insurance. So basic insurance policies cover approximately $100,000 of liability coverage. However, as your net worth increases, you should also increase this coverage. A lot of people with high net worth decide to purchase a personal umbrella policy. And what this is basically your insurance will provide protection ranging from $1 million to $10 million against any lawsuits and judgments. If you're a person that works in an industry where you are actually more exposed to lawsuits, being sued, this policy is very important because you don't want to cover the cost of a lawsuit yourself, and you can actually get insurance for that. However, your personal umbrella policy does not go into effect until your automobile or homeowners insurance coverage is exhausted, which means that if you have the basic policy that covers around $100,000, your homeowners insurance will cover that $100,000. And apart from that, what's left over, your personal umbrella policy will come into effect. You're going to be protected from $1 million to $10 million. As for the last section of the chapter, I'm going to discuss co-insurance and the 80% rule. So basically, co-insurance is a cost-sharing agreement between the person being insured and the insurance company. Basically, what is going on in this agreement is that the co-insurance provision requires the holder to pay a portion of their own losses. This is known as the deductible. Let's say you have a deductible of $1,000 in your car insurance. If you have an accident and you must replace, let's say, a tire that costs around $300, and you are actually not covered for those $300 because you have to, since your deductible is $1,000, you're liable for that first $1,000, and after that cost, then your insurance will cover the rest. Many insurance companies go into co-insurance because they believe there's a certain adequate level of insurance that a person must purchase. And if you do not reach that adequate level of insurance, that's where the co-insurance comes into play and where you have a deductible. Most companies follow the 80% rule, which means that you should cover for 80% of the value of the asset. This is most common in homeowners insurance policies. So as you can see, next up, the 80% rule requires you to purchase insurance to cover at least 80% of your home's full replacement cost. This does not include personal property. However, if you do decide to insure your house for less than the 80% of its replacement value, in the event of a loss, you have two options. You will get the greater of the two options: the actual cost value of the portion of your house that was destroyed, or the amount of insurance purchased, which will be calculated by 80% of the replacement cost times the amount of the loss. Most insurance companies do recommend that you cover for at least 80% of its value, and you are a lot more protected if you do meet the 80% rule. At the end of the day, it's a mistake if you're not meeting this 80% rule. So the one lesson that you should take away from my part of the presentation is that in the future, if you're insuring your home for at least 80% of its value. Thank you.
Hello, everyone. My name is Ari Feldman, and now we'll be talking about keeping insurance costs down. First, let's talk about where insurance costs come from. In recent years, insurance companies have turned to credit scoring models to help them identify customers who are most likely to make claims. From this strategy, companies have developed the insurance credit score. This score is based off the same information as a traditional credit score, but it's used to determine your home and auto insurance rates instead. So as your insurance credit score goes down, the higher your homeowners and automobile insurance rates will be, and vice versa. The insurance credit score is basically the same as a traditional one, except there's greater weight given to payment history and less weight given to the types of credit that you've used in the past. For whatever reason, people have identified a relationship between a person's credit score and their insurance loss ratio, which is a measure that includes claim frequency and the cost of homeowners and automobile insurance. In the graph on the left, you can see this relationship represented visually. In the 1980s, insurance companies recognized the value of this measurement and started using it to set rates. Insurance companies are always going to try to assign rates to correctly represent the cost of claims. Companies have used age and gender information to set rates for years. And for example, men pay more for auto insurance than women because according to the National Security Council, men are 69% more likely to be driving in fatal automobile accidents than women. Also, drivers aged 16 to 20 are 2 to 3 times more likely to have an automobile accident than older drivers, so rates are generally higher for younger drivers. Now we're going to discuss how to keep insurance costs down. We're going to focus on homeowners insurance here. The 3 basic factors to determine the cost of homeowners insurance are the location of your home, the type of the structure, and the level of coverage and policy type. Location affects coverage because of different crime levels and regional perils, which are earthquakes, tornadoes, hurricanes, etc. Older and less sound structures are going to cost more to insure because they're more likely to have problems. And finally, the coverage and type of policy matters because it gets more comprehensive, the more the policy will cost. Now that we know the components of homeowners insurance, we can discuss the discounts and savings that are available for it. The first of these is the high deductible discount. The deductible is the amount that you agree to pay before insurance coverage kicks in. The larger the deductible you are willing to accept, the less you pay for insurance coverage. Typically, insurance companies offer a $250 deductible and provide discounts if you're willing to accept a higher deductible. While this is a good option for savings, only take a higher deductible that you can afford. And now we can go over some of the other available discounts. Multiple policy discounts are provided by insurance companies to customers who have more than one policy with them. Many insurance companies also offer discounts from 2 to 5% for installing security and smoke detector systems, and some even offer discounts for installing sprinkler systems. Also, if you pay your insurance premiums annually, if they're paid off in one annual lump sum instead of quarterly or other payment options, most companies will give a discount. You should also consider a direct writer. A direct writer is an insurance company that does not use agents to distribute their products. This means they do not pay salaries or commissions to those would-be agents and can afford to offer lower prices directly to consumers. Next, you should shop around. Compare prices between high-quality insurers. Premiums can vary as much as 25% between these companies, and also be sure to double-check your policy and make sure you'll be receiving what you ordered. Finally, there are some common discounts for things like homes made with fire-resistant materials, homeowners over the age of 55, and brand loyalty, which basically if you stay with the same insurance policy in the same carrier for a long time, they'll give you a discount. Aside from discounts, another way to save on your insurance costs is to work on improving your credit score. You can do that by paying your bills on time, tracking your spending and making a budget to pay down debt, not canceling long-term accounts, not adding cards to increase borrowing capacity, and making sure your financial life is in order and repeating those steps. Now, just because you have purchased an insurance policy doesn't mean you're all set. An insurance policy cannot make good on an insurance company cannot make good on your policy and pay you for a loss if they don't know what you have lost and what it was worth. To provide effective protection, you'll need to establish proof of ownership and value your assets using a detailed inventory of everything you own. If you cannot prove you owned a computer worth $1,500, for example, your insurance company will not be able to reimburse you if it's stolen. To make an inventory, agents can provide you with an inventory worksheet or you can get one online. Ideally, the inventory should be as detailed as possible and include the date of the purchase, the cost, the model number, the serial number, and brand name for every item. When your when your inventory is complete, you should keep it in a safe place outside of your home, like a safety deposit box or a family member's home. Why not keep it yourself? If your house burns down or endures a natural disaster, you would lose all of your belongings and the inventory that you used to track them. Now we can go over how to collect the loss, and in this checklist, we'll walk through it. First, you're going to report all of your losses immediately. In a case of a theft, report the incident immediately to the police. If a credit or ATM card is stolen, you should also notify the issuing company. In addition, you should notify your insurance agent. Make temporary repairs to protect your property. If your house has sustained damage and your insurance agent hasn't had the time to inspect it, don't let the damage sit untouched. Board up broken windows and holes in the roof or walls and prevent any further damage and protect your home against further theft. Make a detailed list of everything lost or damaged, which is where your inventory comes in. You'll put together a detailed list describing the items that were lost or damaged and present their value on this list to your insurance agent and the police. You'll maintain your records of insurance settlement process. So you'll keep records of all your expenses, and then you'll confirm your adjuster's estimate. Your insurance company will send an adjuster to evaluate the claim and recommend the insurance company a dollar amount for the settlement. Before settling, get an estimate from a local contractor on how much repairs will cost. Don't agree to anything less than fair settlement. From here, that concludes my section. I'll be passing it off for part 4.
So welcome to part 4 of our presentation. My name is Michele Di Carlo, and I will be talking about automobile insurance and filing a claim. Automobile insurance. Most of us have been through the process of getting auto insurance for our cars, since in Florida it's allowed to have auto insurance. Most auto insurance policies are what are called PAP, Personal Automobile Insurance Policy, which is a standard among the industry. Each policy contains both property damage coverage and liability. Each insurance packages is divided into 4 main components that is mostly standard among the industry. The 4 basic parts are: the part A is liability insurance. This coverage protection if you are legally liable for bodily injury and property damage caused by your automobile, including judgment awarded, court fees, and legal defenses. The part B is medical expenses. This covers the medical bills to you and your passengers in case of an emergency, including funeral expenses. The part C is uninsured motorist protection. This is required by many states and covers bodily injury if crash or an accident happens with an uninsured driver. And the part D is damage to your automobile coverage. This is not collision or comprehensive insurance. Covers any damage that happened to your car if you crash with something that is not a car, and although if it's a car, it also covers it. And it also covers a theft of your car. How to read your insurance policy. There are 2 types of insurance quote. The most common is quoted as a split limit coverage. This separates what is the maximum that coverage for each category, and it's written like this. For example, always the first number, in this case 200,000, is for bodily liability coverage, meaning that the person at most will receive 200,000 in liabilities for losses. The second number is the maximum total for each accident. The sum of all the payments that the insurance is gonna be capped at 600,000. And the last one is for property damage and liability coverage. That means that will be paid out in the maximum that will be paid out in total for property damage and liability costs of an accident. The other one is the combined single limit coverage. It is quotes a total number for what will be in an accident. So in this case, it's 100,000 is the total liability insurance. Both liability and property losses in an accident might be capped at $100,000. What is not covered by PAP insurance? if you unintentional damage your vehicle or injure something. If you drive a vehicle without the owner's consent, you can lend your car and it will still be covered by your insurance only if you give consent to that driver. Using a vehicle with fewer than four wheels, for example, if you get a car without and your tire is exploded and you continue driving, it will not be covered by insurance unless if an accident. Of course, if you do it by accident, it will cover it, but if it's on purpose, it will not cover it. Using another person's vehicle regularly, if you use someone's vehicle on a regular basis and you are not on their insurance policy, it will most likely void the insurance and not pay anything. If you have a car that is not listed on your insurance policy and you use it, it will most likely continue with your insurance. It will not be covered. If you use your vehicle for commercial purposes or carrying passengers for a fee and you don't have an insurance that is comprehended for that or is intended for that, it will be voided in case of an accident. Or if you drive on a race or a speed contest, your insurance will not cover damages or accidents that will be caused as a part of it. No fault insurance. There are several states that require this. This makes the insurance company protects you in the case of an accident, regardless who is at fault. Over half of the United States have this system, including Florida. Florida has a no fault, is a no fault state, and imposes limit on medical expenses and other claims that might not be covered by all. If a car crashes you and the insurance is not enough to cover your expenses, your insurance needs to pay the difference, although it was not your fault, the accident. There are many determinants of the cost of the insurance. First, the type of automobile. If you have a sports car, it will be more expensive than if you have a regular car. The use of your automobile, if it's a car that you only use for vacation or to go to work, the price will vary. Your driver's personal characteristics, your driving record. Of course, if you have multiple tickets and multiple accidents, your insurance will go up. Where do you live? Insurance in Miami will be more expensive than insurance in a rural low traffic area because in Miami there is a more highest accident rate. The discounts you qualify for when you are putting insurance. If you're a student and have more than 3.5 GPA, you get a discount. If you're members of some fraternities, you also get a discount. There are many companies offer discount. If you're a veteran, you get a discount. Your credit score impact your insurance rate. So if you have a higher credit score, you get a lower rate. So keeping your insurance costs down. Shop comparatively. You should go and look for many quotes, since the companies sometimes most of the time will quote you very different prices. Consider only high quality insurance. You can get a quote for a cheaper quote for low rating insurance, but at the end it will prove more expensive because at the time of the accident will be a hassle to pay or they will not pay. So it's recommended to stick to large companies like Geico, State Farms, Progressive. Take advantage of all the discounts. They are not going to give it to you, instead you ask for them. Buy a car that is relatively expensive to insure if you're on a budget, of course. Instead of buying a sports car, a two-door car, buy a four-door car. This will actually lower your insurance cost, improve your driving records, avoid getting tickets or being on accidents. Raise your deductible. Your deductible is what you pay in an accident. So, for example, if you get a $10,000 crash and your deductible is $500, you pay the $500 and the insurance will cover the rest. If you raise this, your monthly payment will be decreased. If you are a safe driver, this can actually benefit you. And keep the adequate liability insurance for the car you drive and for the area you live. Filing a claim. In case you got on an accident, it's very important to know what to do. At the time of the accident, the most important thing is to get help for the people that is injured. You need to move the car. If you got an accident in the middle of the highway, it's safer, if it's possible, to move the car out of the way. Get identification of all witnesses that saw the accident in case this goes to court. Cooperate with the police so they can write an adequate report. If you believe the other driver is intoxicated, make them test, and you as well, and a DUI test because although it might be your fault, but if they are in a DUI, you will win the crash. Write down your recollection of the accident at the time of the accident, since the more time out, the more away you are from the accident, most likely you are to forgot some things. Don't sign or appeal guilt to anything. It's better to contact a lawyer at the moment and do not get information if it's your fault. It's better to don't admit guilt and contact a lawyer. Get a copy of the police report and make sure it's accurate. Of course, you need to compare it to your facts. After the crash, you need to call your insurance agent as soon as possible to file a claim. Their number is usually on their webpage. You cooperate with insurance. You tell them the story. Always stick to one story. Do not change it. It's the truth. Just stick to the truth. Cooperate with your insurance. Keep record of all expenditures associated with the accident because they most likely will be covered by your insurance. If it's a serious accident, meet with a lawyer and know your rights. If you kill someone or or you injure severely something, always it's better to go with a lawyer. So thank you for your attention.